Silver moved 8% in a single day. And most of the analysis you are going to hear about it is wrong. Not slightly off, not missing a few nuances. Wrong in ways that could genuinely cost you money if you act on it. The price reached $94.30 per ounce. Gold hit $5,275.82. U.S. and Israeli forces launched joint strikes on Iran in operations called Epic Fury and Roaring Lion. The market reacted fast and hard. All of that is real. But underneath this move, there is a claim being recycled across every precious metals platform right now that has been factually debunked. A leveraged short position that just lost $233 million in 10 days. And a question about $200 silver that deserves an honest answer instead of a hype-driven one. That is exactly what this is going to be. Before anything else, if you have been following Element Axis for a while, you already know that this channel does not operate on hype. It never has. The goal here has always been to hand you the actual picture, not a version of it designed to make you feel a particular emotion, and not a version shaped around someone's sales agenda. If you are new here and you're watching this because silver just exploded and you want to understand what is actually happening, do yourself a favor and hit that subscribe button right now. Not because everyone says that, but because the next few months in precious metals are going to generate an enormous amount of noise, and you are going to want a place that filters that noise into something you can actually use. So subscribe and let us get into it. The strike operations were named Epic Fury on the American side and Roaring Lion on the Israeli side. These are not small-scale engagements. These are not proxy skirmishes. This is direct coordinated military action involving the United States and Israel striking Iran simultaneously. Markets understand scale. Markets understand consequence. And the reaction in precious metals was immediate because when the world feels genuinely unstable and real conflict is happening between major powers, money moves into gold and silver. That has been true for thousands of years, and it was true the moment those strikes were confirmed. Gold rose 1.75% to $5,275.80 tau per ounce. For February 2026 alone, gold was up 7.84%. That is a month that gold investors are going to remember. But silver's move was the one that really turned heads. An 8% single-day surge is the kind of number that makes even seasoned traders stop and pay attention. When you have been in these markets for a while, you start to understand that moves that large in a single session carry real weight. They do not happen because of a rumor or a tweet. They happen because significant capital is moving in one direction, fast, and for reasons that matter. Now here is where I need to slow down and have an honest conversation with you. Because what I am about to tell you goes directly against one of the most repeated narratives in the precious metals space. And I know that might be uncomfortable for some of you. But the data is clear, and I would rather give you the truth than give you a comfortable story that helps someone make a financial decision based on a lie. For years, maybe the better part of the last decade, a very specific claim has been circulating in precious metals communities. You have probably heard it. The claim goes like this. Tomahawk cruise missiles contain 482 ounces of silver. Some versions say 500 ounces. The argument is that when a missile is fired, that silver is destroyed, gone, non-recoverable, permanently removed from global supply. So every missile fired in any conflict anywhere in the world represents hundreds of ounces of silver that will never come back. And therefore, military activity is a massive ongoing drain on silver supply. And this drain supports prices going up. It sounds logical. It sounds specific. It has numbers attached to it. It gets shared constantly. And it is almost entirely false. A report from CPM Group, one of the more credible research outfits in the commodities space, has now gone on record to expose this narrative for what it actually is. According to their research, informed sources within the defense and manufacturing industries have confirmed that the actual silver content in a Tomahawk missile is approximately 10 to 15 ounces. Let that land for a moment. The claim people have been spreading says 500 ounces. The documented reality is 10 to 15 ounces. That is not a small discrepancy. That is an exaggeration of more than 30 times. They told you 500. The real number is somewhere between 10 and 15. The actual silver content has been inflated by over 97% in the story that has been repeated across forums, YouTube channels, and social media posts for years. And where is this silver actually located inside the missile? The promoters would have you believe it is spread throughout the entire system, deeply integrated into critical components. The reality, according to documented findings, is that the silver is found primarily in solder and in ignition batteries. That is the extent of it. Solder and batteries. Now, what about the smaller missiles being used in Ukraine and the Middle East right now, the missiles generating the most news coverage? These smaller missiles, according to the same research, contain less than 1 ounce of silver, less than a single ounce, also located in solder and ignition batteries. Let me give you the real math here, because this is where the false narrative falls apart completely. If you believe the 500-ounce claim and assume the U.S. fired 100 missiles in a given operation, you would calculate 50,000 ounces of silver consumed. That is the number designed to make you feel urgency about supply. But the real calculation is 100 missiles multiplied by 15 ounces, which gives you 1,500 ounces. The difference between the false number and the real number is 48,500 ounces. And for smaller missiles being fired at volume in current conflicts, hundreds of missiles times less than 1 ounce each means a few hundred ounces at most. Now consider the scale of the global silver market. Nearly 1 billion ounces of silver are produced annually. A few hundred ounces for missile use, or even 1,500 ounces, does not register. It is a rounding error so small it would not appear on a chart. The narrative that military conflict is meaningfully draining global silver supply through missile launches is not supported by the actual numbers in any way. Now, I want to be very direct about something. The reason I am telling you this is not to be bearish on silver. When I see a false narrative propping up part of the investment case for an asset, it worries me about the credibility of everything else being said. Because if someone told you that missiles contain 500 ounces of silver when the real number is 10 to 15, what else have they gotten wrong? When new investors find out that a number they were confidently told turns out to be off by a factor of 30, they do not just update their view on missiles. They lose trust in the entire community that spread that information. The real bullish case for silver does not need any of this. Industrial demand from solar energy is enormous and growing. Every solar panel installed anywhere in the world uses silver. The transition to electric vehicles is driving silver consumption at scale. Electronics manufacturing uses silver across semiconductors, connectors, and circuit boards. Supply deficits in the silver market have persisted for years. Central banks globally have been increasing exposure to precious metals. Physical premiums have remained elevated even during price corrections. These are real dynamics. These are measurable. These are more than sufficient to build a compelling investment case without fabricating a single number. Build your understanding on the real case, not the manufactured one. And drop a comment below telling me where you are watching from. I see viewers from all across the country, and I want to know where this community is based. Now let me shift to something that is documented on chain, which means it is publicly verifiable and not speculative in any way. Market monitoring has identified a specific blockchain address that opened short positions on both gold and silver approximately 10 days before the US-Israeli strikes on Iran. This position used 4 times leverage on gold and 3 times leverage on silver. If you're not familiar with how leverage trading works, here is the key point. When you use leverage, your gains and losses are amplified by the leverage multiple. If you use 3 times leverage and the market moves 8% against you in a day, you do not lose 8% of your position. You lose 24% in that single session. The result of this position, as of the most recent data, is a loss of $2.33 million, $2,330,000 lost in 10 days betting against precious metals. This is a significant leveraged position that has been systematically destroyed by a market moving powerfully in the opposite direction. Think about the timing. This position was opened 10 days ago. Whoever put it on was betting that gold and silver would go down before the Iran strikes happened. Before Epic Fury, before Roaring Lion, before silver moved 8% in a single session. They were betting against safe haven demand. They were betting against geopolitical risk, and the market has punished them for it. Now here is why this matters beyond the headline number. This position is on chain and therefore visible, but most financial positions are not on chain. Most positions exist in traditional brokerage and fund accounts that are not publicly visible. If there is one documented short position that is $2.33 million underwater, the logical question is, how many undocumented short positions exist in the same condition right now? How many funds, how many institutional traders, how many professional short sellers positioned against precious metals are now watching their screens in pain as silver surges? This matters because of something called a short squeeze. Here's how it works. A short position profits when the price of an asset goes down. If you are short and the price rises instead, you're losing money. When you're short with leverage and the market moves hard against you, your losses accumulate quickly. At a certain point, your broker will issue a margin call demanding you add more capital to cover the losses. If you cannot add that capital, the broker forcibly closes your position. Closing a short position means buying back the asset you were short on. Buying pushes prices higher. Higher prices hurt other short positions. Those short sellers face their own margin calls. They are also forced to buy. More buying drives, prices even higher. The dynamic feeds on itself. This is the short squeeze. And when significant leveraged short positions are caught in a fast-moving market, the squeeze can become explosive. I'm not telling you a massive short squeeze is guaranteed. What I am telling you is that the conditions are developing. We have documented proof of at least one major short position that is millions of dollars underwater. We have a significant geopolitical catalyst in the form of direct U.S.-Israeli strikes on Iran. We have silver already having moved 8% in a single day. And we have markets expected to open at significantly higher prices when trading resumes. The pieces are in place for something larger to develop. Whether it does depends on variables that nobody can predict with certainty. But the setup is real, and it is worth understanding. If you are finding value in this breakdown, hit the like button. It costs you nothing, and it genuinely helps get this analysis in front of more people who need it. Now let us address the targets circulating everywhere right now, because I know many of you have seen the headlines talking about $200 silver and $6,000 gold. So let me give you an honest assessment, which means I'm going to give you both sides without telling you what you want to hear. For gold to reach $6,000 from current levels around $5,175, that would require an additional gain of roughly 14%. In the context of where gold has already come from, that is a meaningful but discussable number. For silver to reach $200 from current levels around $94.30, that would require more than doubling from here. More than 100% gain from current prices. That is a much bigger ask. That is the kind of move that requires not just one good catalyst, but sustained, ongoing, powerful demand over an extended period. Are these targets possible? Yes, they are possible. Are they guaranteed or even likely in the short term? Absolutely not. Achieving targets like $200 silver or $6,000 gold would require persistent demand maintained over weeks or months, not just one day's worth of safe haven buying. It would require global instability to remain at a high enough level that investors continue moving money into precious metals rather than back into risk assets once things settle. It would require the geopolitical situation to escalate further, or at minimum, to not de-escalate quickly. If the conflict between the US, Israel, and Iran is resolved through diplomatic channels faster than markets expect, the safe haven bid fades. The urgency disappears. Profit-taking begins. Prices correct. This has happened before. Markets have seen safe haven spikes during geopolitical events that lasted days before reversing when the immediate fear passed. Anyone who confidently tells you silver is going to $200 is not being straight with you. And equally, anyone who dismisses that target as impossible without acknowledging the scenarios under which it could happen is not being straight either. Uncertainty is the honest answer. What matters is having a framework for thinking about multiple outcomes rather than committing emotionally to one. Here is something genuinely important for anyone in the 45 to 55 plus range watching this, because I know this audience and I know the questions running through your heads. Many of you have been accumulating physical precious metals for years. You bought silver when it was much lower. You bought gold when it was much lower. You have been through the big swings. You remember 2011 when silver ran up and then crashed hard. You have seen this movie before, at least in part. And the experience you carry from those years is actually your biggest advantage right now. The long-term holders of physical metal are in a completely different position than traders watching paper contracts on screens. If you're holding physical silver and gold, a price surge of 8% in a day is confirmation of a thesis you have been developing for a long time. It is not a reason to panic or change strategy. It is not a green light to go lever up and chase the move. It is a moment to take stock, appreciate that the underlying logic of holding real assets in an unstable world is playing out, and continue doing what you have been doing with discipline. Short-term traders are in a different situation. If you're trying to time entries and exits on paper positions, the risk of chasing a move that has already happened is very real. Gaps up can be sold into, extended moves can reverse sharply, and if you're adding leverage to chase something that has already moved 8%, you are taking on risk that needs to be managed very carefully. The trader who just lost $233 million in 10 days made a directional bet with leverage. They bet wrong. That can happen on the long side just as easily as the short side. If you are trading, keep your position sizes small, use stops, and accept the possibility of being wrong. Now let me spend a few minutes on the structural forces that matter more than any single price target or near-term catalyst. Because the loudest voices in precious metals right now are focused on the 8% move in the Iran strikes. Those things are real and worth discussing. But the underlying forces that have been building for years are actually more important. Global debt levels are not contracting. They are expanding. The United States national debt is at levels that would have been considered catastrophic by economists just 2 decades ago, and it is not slowing down. Governments across the developed world are running deficits that require continuous monetary expansion to finance. Central banks engage in equivalent policies to support this spending. When you continuously create more units of currency, each unit is worth slightly less over time. That is not controversial. That is basic economics. And the natural response? The response that thoughtful investors have made for thousands of years is to hold assets that cannot be printed, assets that exist in the physical world in finite quantities, assets like gold, assets like silver. The industrial demand picture for silver continues to strengthen in ways that have nothing to do with geopolitics. Solar energy is one of the fastest growing sectors in the global economy. Silver is a core input in photovoltaic cells. Every solar panel installed anywhere uses silver. As countries commit to energy transition goals and as solar becomes economically competitive with fossil fuels in more markets, the demand from this single sector alone is significant and growing. Electric vehicles use more silver per unit than traditional combustion vehicles. As EV adoption accelerates globally, that demand accelerates with it. New silver supply is constrained by the realities of mining. You cannot build a new mine overnight. The lead time from discovery to production is measured in years, sometimes decades. The richest, easiest deposits have largely already been found. New deposits require mining in more remote environments at higher cost. So you have a picture where demand from multiple growing sectors is increasing while new supply faces structural constraints. Supply deficits have already persisted for years. All of this exists before you add any geopolitical catalyst on top of it. This is why the false missile narrative is so unnecessary. The real story is already compelling. You do not need to inflate missile silver content by 30 times to make the case. The actual industrial demand picture, combined with the monetary policy environment, combined with geopolitical uncertainty, is more than sufficient. Let me walk you through what to actually watch in the coming days, because the situation is evolving quickly, and what happens next will matter enormously for where prices go from here. The first thing to watch is what happens when markets open at the start of the trading week. A gap higher is expected, but the gap itself is not the story. What happens after the gap is what matters. Does the price hold above the gap level and continue moving higher? Or does it open high and get sold back down as traders take profits and new short sellers see an opportunity at elevated levels? The first few hours of trading will tell you a great deal about the sustainability of this move. Watch the volume. Watch whether buyers remain present after the initial excitement. Watch for any signs of distribution into strength. The second thing to watch is the dollar and central bank behavior. Commodity prices, including precious metals, are priced in dollars globally. When the dollar weakens against other major currencies, commodities become cheaper for foreign buyers, which tends to increase demand and support prices. When the dollar strengthens, the opposite applies. Watch the dollar index, watch Fed commentary, watch how major central banks respond publicly to the increased uncertainty. The third thing to watch is the conflict itself. Whether silver continues higher or reverses depends more on what happens militarily and diplomatically in the Middle East than on any other single factor right now. If the conflict escalates further, the safe haven bid continues and potentially intensifies. If diplomatic channels open and there are credible signs of de-escalation, the safe haven urgency fades and markets may give back a significant portion of what they just gained. Nobody can predict which direction this goes. The honest framework is to understand both scenarios and have a plan for both. One more thing I want to address because I see it playing out in real time across social media and comment sections everywhere. When markets make big moves, the information environment gets polluted fast. People with no track record suddenly become very confident voices calling for dramatic price targets. Content designed to generate clicks rather than help you make better decisions floods every platform. Here are a few things to keep in mind as you consume information over the coming days. Ask yourself whether the person presenting information is acknowledging uncertainty or claiming certainty. Legitimate analysis almost always acknowledges that outcomes are uncertain and multiple scenarios are possible. Be skeptical of anyone who gives you a specific price target with high confidence and no caveats. Ask yourself whether the person is giving you both the bullish and the bearish case or only one. One-sided analysis, no matter which direction, is usually shaped by an agenda. And remember what happened with the missile silver content narrative. A number got repeated so many times with such apparent confidence that most people assumed it had been verified. It had not. The real number was off by a factor of more than 30. If that can happen with something as specific and verifiable as the silver content in a missile, it can happen with any number being thrown around right now. Let me leave you with 3 things to actually carry with you from everything we have covered here. The first is about separating truth from narrative. The claim that Tomahawk missiles contain nearly 500 ounces of silver is false. The documented reality is 10 to 15 ounces. Smaller missiles contain less than 1 ounce. In a market producing close to 1 billion ounces annually, military missile use is not a meaningful supply factor. This narrative has been repeated for years by people who either did not check the numbers or knew the numbers were wrong. When you encounter bold claims about precious metals going forward, apply basic scrutiny before accepting them. The second is about what is actually happening in the market right now. There is documented on-chain evidence of a significant leveraged short position that has lost $2.33 million in 10 days betting against gold and silver. This is verifiable. This is real. And it almost certainly represents only a fraction of the underwater short exposure that exists across markets right now. The conditions for a broader short squeeze are developing. The US-Israeli strikes on Iran are exactly the kind of catalyst that can accelerate these dynamics. This is a real market structure story, not a manufactured one. The third is about maintaining perspective on price targets. Gold at $6,000 and silver at $200 are numbers being seriously discussed by market participants in the current environment. For gold, that represents roughly a 14% additional gain. For silver, it represents more than doubling. Both are possible under scenarios where the conflict escalates and safe haven demand remains persistently elevated. Neither is guaranteed. Both require conditions that are not in anyone's control to predict. Have a framework that works across multiple scenarios rather than betting everything on one outcome. The 8% single-day move in silver is real. The geopolitical catalyst behind it is real. The short positions getting destroyed are real. The potential for further movement is real. And so is the uncertainty about which direction comes next. These things coexist. They always have. The investors who navigate markets like this successfully are the ones who hold both the opportunity and the risk clearly in mind. At the same time, who do not let excitement blind them to downside scenarios and do not let fear blind them to genuine opportunity. Invest with logic, not hype, not fear. Logic grounded in real data, real fundamentals, and an honest assessment of what we know and what we do not. That is the standard at Element Axis, and it is the standard I encourage you to apply to everything you consume in this space going forward. Stay subscribed, stay engaged, and share this with anyone in your circle who is trying to make sense of what is happening in these markets right now, because the facts here are more powerful than any story someone could invent to replace them.